Hi there, welcome to Property Talk with Terence Wong. My name is Terence Wong and I'm a 14-year real estate agent. I'm also a 4 times property PropNext millionaire, but more importantly, I am a real estate investor just like you. I've in fact been investing in real estate for longer than I've been a real estate agent for the last 16 years, and to date I've amassed about an 8+ million property portfolio. Today, I'd like to share a tip with you guys on how to track the financial performance of your property. Now, why is it important to track the financial performance quantitatively, not qualitatively? So, if you go to any show flat agent and say, oh yeah, buy freehold, it's the best. But is it necessarily so? How do you then quantitatively compare product A versus product B versus product C? My answer to you is to be able to create a financial model that tracks the metrics. For property, there are only 3 things that you must bear in mind. Number 1 is your starting point, which is the equity that you have put in. If you buy a $2 million property, the equity you have put in is $500,000. Number 2, you must track the cash flows, the positive cash flows and the negative cash flows. What are the positive cash flows in a property? There are only 2 items. The capital gain. If you bought your property for $2 million and you sell it for $3 million, your capital gain is $1 million. If your rentals that you have collected over 10 years is $500,000, then your rental cash flow is $500,000. What are your negative cash flows? Number 1, stamp duty. Number 2, the interest that you pay on the bank loan. Not the monthly mortgage payment, but only the interest component, which is the amount that you pay to the bank for lending the money. Number 3, your sales fee, which is your exit cost when you need to sell the property. Number 4, your maintenance fee over the period of your investment horizon. Number 5, your property tax over the investment horizon of your investment period. The third component is you take your positive cash flows minus your negative cash flows and you come up with your net end figure. So, for example, if you started with $500,000. You have accumulated cash flows positive minus your negative cash flows of another $500,000. That means from $500,000 you have made $500,000. Your ending point is 500 plus 500, $1 million. And this is over 10 years. If you use a CAGR calculator, which is a cumulative annual growth rate calculator, you can just Google it and you find it on any web page. You put in your starting point 500, you put in your end point, which is your profits, plus your base equity 500 plus 500, 1 million over a period of 10 years. If you press the calculator, you'll come up with a figure of 7.07%. That means your equity or your initial equity or / investment has grown at a compounded rate of 7.07% per year over 10 years. Now, why is this figure important? Because it allows you to have a basis of comparison negating the effects of time. You can't just, for example, a lot of property analysts, they say, oh, your return of investment, your return of equity is 200%. But 200% over 5 years and 200% over 20 years are 2 drastically different things, which is why you need to annualize the figure. And when you annualize the figure, it becomes the best basis of comparison, because then you can confidently say, whoa, okay, my property has grown, or my investment metrics for this property is 7%. Should I leave my money in CPF? No, because CPF only pays 2.6%. 7% is bigger than 2.6%. Should I instead put it in a fixed D? 3%? No, 7% is obviously better. And they are both low risk. Should I, for example, how about DBS? He pays about a dividend of 5% plus he has capital gains. Maybe, but that is a question for another episode, because we're not here to talk about risk and reward and metrics, but rather we are just here to educate and to give you a tip on how to quantify your investment in property so that you can have a quantitative figure. Now, next, we'll go to a next actual example. Now we're going to use an actual real-life example to show you and to calculate with you how do you get the annualized rate of return or cumulative annual growth rate, CAGR. Now, this is, I'm going to use an example of my own property that I actually invested in, and this is River Isles that we actually bought. You can see unit number 0410. So we actually bought this property in 2012 on plan from the developer, and we exited in 2021. So here I'm just going to go through the metrics with you. The holding period was about 9 years. The length of mortgage was about 30 years. And the interest rate was mostly predominantly low. But on average, we use an interest rate of about 2% because there were some spikes on 8 and 1.9 where it went up to like maybe 2.7%, etc. Back then, you only needed 20% to invest, so the investable equity was 184,000. So remember three things: investable equity, positive and negative cash flow, and then the final amount. All right, so what do we want to come up with all these three numbers now? Starting number, purchase price 920,000, so investable equity amount was 184,000. Positive cash flow, it was bought at 920,000 and sold for 1.175 million. And so the capital gain was about 255,000. What else? What are the other positive cash flows? Rental income. It was a BUC project, so construction was about 3 years, and rental was about 6 years. 2 years 2006, 2 years 2008, and then the final 2 years 3000. There is power in rental income. Over the 6 years, if you add it up cumulatively, it is worth $185,000. So the net total positive cash flow is about $440,000. Now, what do we less? We less the stamp duty, 22,200. We less the sales fee, 2%, 25,600. We less the maintenance fee over 9 years of $300 per month, which is about $32,000. And we less the interest costs over 9 years of about $118,000. And the last one, we less property tax, which is about $21,600. Property tax annual value estimated about $20,000 a year. And so at 12% of that is about 2,000 plus multiplied by 9 years. Total net gain, 439,000 minus away all the negative cash flows, you come up with a net gain of about 219,000. So your starting point was 184,000. The ending point is 184 plus your profits of 219,000, which is 403K. 184K, 403K, 9-year holding period. If you use a CAGR calculator, you come up with a cumulative annual growth rate of 9.11%, which means that your money has grown on an annualized basis of 9.11%, which is, again, larger than the magic figure of 7.07%, which is why you see it has more than doubled from its initial 184,000. In just 9 years, 184,000 has grown to 403,000, which is really not bad for a day's work. You know, you invest 184,000, 10 years later, boom, it becomes 403,000, just 9 years. I won't say risk-free, low risk, and very stable. But we are not here again to discuss the merits of property, but just to give you an example and to teach you how to basically quantify and to come up with the quantifiable financial model. If you like what you see, please like that smash button, and like, it really helps to grow our audience, and we are really hoping to start this channel in a big way. So in the next episodes and coming up, we'll talk about real exciting stuff. I don't want to talk about things that might sound salesy, etc., this launch, that launch, but I actually want to talk about intrinsic investment values that might be helpful to you, and really how to analyze things and how to choose things from a non-partisan basis. So see you next time on Property Talk with Terrence.